back to my channel. So what is liquidity? Okay, because as my strategy name is liquidity strategy, so what's liquidity? Liquidity is a stop losses of lots of traders. Okay, so now there is every time somebody is buying or somebody is selling. Okay, and if somebody wants to win with a buy position, then somebody else will lose with a sell position. Okay, so that's how what's the liquidity? Liquidity is everywhere in the market. Okay, it's everywhere and it represents the stop losses, buy orders, sell orders, buy limits and sell limits. Okay, all these creates a liquidity in the market, and the big traders, those who move the market, okay, those who manipulate the market, they need liquidity. So what does it mean? It means that they need stop losses. Okay, so when they'll need the stop losses, so they will look where all the traders are putting their stop losses. Okay, and then they will do the opposite of it. So suppose, look into this example. Wait. So okay, let's see over here. So here we can see that from the Asian session in Nasdaq. Okay, and you can do it on any time frame. It's like you can do multi-time frame analysis for a context. Okay, like 1H time frame, you can think about your context in 1H time frame, and then you can take trades in 5-minute time frame. But you can do this in a single time frame also, so you don't need any other time frame. You can do it on 5-minute, 15-minute, 1H, or anything. Okay, so now if you look at over here, it was a clear trend line. Okay, it was a very good trend line over here, and then there was a trend line break and this was the origin of the trend line. So now lots of the traders, what they'll think that this line over here is support. Okay, this is a support zone, and now what they'll do, they'll try to buy it from here by marking a demand zone like this, and then they will buy over here, and their stop loss will be a little bit below of this structure like this somewhere. So now the market makers, they know that what are the psychology of the retail trader. Like they know everything about it, like they know what the people will do, and they just assume, okay, that people will put the stop losses over here, and they coded their algorithms in such a way that those algorithms can spot out this liquidity pools. Okay, so over here we know that people will buy from this demand zone, and their stop loss will be a little bit below of this structure, right over here. Okay, and now their stop loss will be hit over here. Okay, so now liquidity is in over here, and now there will be some more traders, those who trade breakout, they will take a sell over here. Okay, and their stop loss will be a little bit above, like 55 points like this. Their stop loss will be like this, and the target will be this low over here. Their stop losses will also get hit. Okay, and now what a smart money trader do, okay, he will look it as a liquidity pool over here. Okay, he will think this is a liquidity zone over here. So what he will do, he will just place his buy limits, like the banks or like the big institutions, like they just, whenever they see that it's doing a fake breakout, they will just start spamming the buy limits over here. Okay, because they have lots of money, they can do it. You just place a one single buy limit over here, and your stop loss can be a little bit like this. Okay, and now what you can do is you can target buy side liquidity. So in this scenario, where is the buy side liquidity? The buy side liquidity is right over here. Okay, so this will be the target, and it hits on the next day in London session, and after that it keeps on, like it rallies from here. Okay, but my point is that over here it's a sell side liquidity, right? This was the sell side liquidity, because there were two types of traders, those who traded in this, like many types of traders, but most prominently, like there were 2 or 3 types of traders. The traders, those who were trading the trend line, they thought like it's a trend line breakout, so what they did, they took a sell over here. Okay, or they waited for the retracement of this trend line. Okay, when they saw the retracement of this trend line, they took sell over here. Okay, and another were this supply and demand players. Okay, and break and retest. So this was the break and retest guys over here. Okay, so they took a sell over here, but their stop loss also got hit, and there was this demand zone over here. So people took buy at the starting of this demand zone, and their stop loss will be a little bit below over here. But what the market did, it just came down and then it just rallies up and takes all the stop losses. Okay, and there are some more traders, retail approach traders, like we are all retail traders. Okay, but the difference is that there are some traders, those who think that these things work. Okay, like they think that the supply, demand and support and resistance works. Yes, it works, but what you have to do is you have to get a really good risk management. Okay, and you have to play with your psychology. Okay, and I'm not saying if you learn this strategy you will be a best trader in this world. Still, you will need to train your psychology, your trading psychology, which is the 90% or 80% of the game. Okay, your trading psychology decides that how good trader you will be. All right, so that's why this is a process. Okay, I'm telling you the process, but the whole path, okay, the whole way you will have to take it. Okay, you have to go through all of your journals, and you have to control on your thoughts and emotions, and you should be aware about the thoughts which you are thinking in your mind while trading or while you are in a trade. Okay, and you should write it down, and you should be very careful and know about that what you are thinking while you are trading. Like that's really important. So this is the good strategy, the strategy which I'm teaching right now. This is the best strategy right now. Okay, this is the best strategy, and this strategy does not die. Okay, and this strategy is like from like so much, like big people they do this. And why people do this strategy? Because if somebody wants to win in this market, somebody else will have to lose. So if big institution wants to win in this market, they need like 100,000 people to lose in the market. Okay, so the 100,000 people will take a sell from this breakout. Like they will think like, oh, it's a good breakout, like we should take a sell over here. Okay, or the people will take buy over here. Like the big institution will screw both of them over here, and they will do consolidation, and the normal retail trader will get mad over here, and he will put big lots, and then they will do what they want to do in the market. Okay, so like this how the market works. So the stop losses were taken over here. So just think about it. If a big institution wants to place a big lot size, like 1,000 lot size, or like 500,000, 10,000 lots, okay, over here. So there is no liquidity at that moment of like 1,000 lots or 2,000, 10,000 lots. So what they'll do, they will create a fake narrative. Like you can see this fake narrative. The market is crashing. Okay, like it's at its all-time high, and now market is about to crash. Something happened in somewhere in Europe or in Middle East, and market will start to fall from now. But no, okay, it will create a fake narrative for the retail traders, and then it will take all the stop losses which was below this low, this low, this low, this low, and this was the main low. This was the daily low right over here, and it took the stop losses of that also. Okay, and now you can take and then what they will do when everybody is looking for sells, because everybody can see this move, right?